Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at applied digital.
If you find our talks useful, please consider subscribe, like, and comment underneath. But before we jump into the charts and all the financial numbers, I really want you to imagine something.
Oh, here we go.
No, seriously, imagine signing a single piece of paper, right? And that one paper guarantees your company $5.2 billion. Not stretched over a century, but locked in for the next 15 years.
That's just a mind-bending amount of scale.
Exactly. And that's exactly the scale we are looking at today. We're breaking down a company that just pulled off that exact kind of deal. We're going to figure out how they're aggressively transitioning from, speculative developer into this absolute titan of contracted infrastructure.
It really is a massive pivot point for them. But before we unpack how that $5.2 billion deal fundamentally rewrites their entire financial future, I just have a quick note on a useful chart tool for investors and traders.
Yeah.
So if you want help reading trading charts a bit more clearly as we go through this analysis, you can check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
Super helpful for visualizing this stuff.
Yeah, and it can be used across markets like stocks, forex, crypto, gold, indices, futures, all that. Just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it doesn't guarantee profits. Trading involves risk, so, always manage your risk and do your own research. And this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. Okay, let's unpack this. We have a stock that has absolutely soared over the last year. It has more than tripled, and it's currently trading around the $40.85 mark.
Yeah, quite the run.
Right. And a huge driver of this momentum is that macro tailwind we hear about literally every single day, the artificial intelligence compute arms race. Everyone is just scrambling for chips. But here's the thing. Applied Digital isn't making the chips.
No, they aren't.
So where exactly do they fit into this wealth-building context?
Well, if we connect this to the bigger picture, you really have to look at the physical reality of artificial intelligence. AI doesn't just, live in the clouds.
Right. It has to live somewhere.
Exactly.
Yeah.
It lives in massive, incredibly energy-hungry physical buildings. So Applied Digital fits the profile of a high-growth infrastructure play. Their entire strategy right now is transitioning from simply building things on spec to becoming this highly predictable, long-duration cash flow generator.
It's a classic gold rush analogy, isn't it?
Oh, 100%.
Like outfitting the miners. But here's where I think it gets really interesting with them. They aren't just selling the picks and shovels. They're building the fully operational, highly specialized, liquid-cooled mines themselves, and then just renting them out to the biggest miners in the world.
That's a great way to put it.
They don't have to pan for the gold. They just own the heavily guarded, climate-controlled facility where everyone else has to bring their dirt to be processed.
That is a brilliant way to visualize it. And, that specific business model relies on two incredibly difficult things.
Which are?
Heavy execution and massive scale. From an investor profile standpoint, this really appeals to growth-focused investors who want direct exposure to the AI supply chain, but, and this is a critical distinction, they want that exposure without taking on the hardware procurement risks.
Meaning they don't want to get stuck holding outdated tech.
Precisely. They don't want to worry about whether a specific chip becomes obsolete next year. They just want to own the real estate that powers whatever chip comes next.
Makes total sense. So the foundation makes sense conceptually. But look, building infrastructure is notoriously expensive. It usually leads to terrible margins early on. Yet, when I look at the fundamentals here, the top-line explosion is just staggering.
Oh, it's wild.
We're looking at a hyper-growth phase. For their fiscal Q3 2026, revenue hit $126.6 million. That is a 139% year-over-year jump.
It's massive. And what is vital for you to understand is that this growth isn't just vanity revenue, right? It's actually making its way down the income statement. Their trailing annual revenue currently stands at $319.3 million. But look at the adjusted EBITDA.
Okay, let's see.
It surged from $6.3 million to $44.1 million.
Wait, let me just pause there. Going from $6 million to $44 million in earnings before interest, taxes, depreciation, and amortization.
Yeah.
That means they aren't just bringing in more money. Their operational efficiency is radically improving as they scale.
Exactly. It is a textbook example of operating leverage. In physical infrastructure, your fixed costs the land, the outer shell of the building, the main power grid connections, those are massive up
Yeah,
front.
you have to pour all that concrete first.
Yeah, but once those are paid for, the cost to service the next client or the next megawatt of power is relatively low. So every new dollar of revenue starts dropping almost straight to the bottom line.
Which perfectly sets up my next question. Because their projected site net operating income margins, or NOI margins, look almost mathematically impossible for a physical business.
They do look crazy on paper.
I mean, they are projecting 88% margins for their Polaris Forge 1 site,
Right.
86% for Polaris Forge 2, and 85% for Delta Forge 1. How on earth do you pull an 88% profit margin out of a physical building?
Well, you do it by having an absolute stranglehold on something the market is completely desperate for. They've essentially built an infrastructure moat which relies on three main pillars: site control, secured available grid power, and direct-to-chip liquid cooling.
Okay, let's drill into that last one, the liquid cooling, because I think a lot of people just picture a traditional data center as a giant warehouse, right, with thousands of computer towers and really, really strong air conditioning blowing through the aisles. Why doesn't that work anymore?
Because the physics have completely changed. These next-generation AI processors from companies like NVIDIA and AMD, they run incredibly hot, like dangerously
It's
hot.
a massive energy draw.
Exactly. They possess a thermal density that is just off the charts. If you put a rack of these AI servers in a traditional air-conditioned data center, the air literally cannot carry the heat away fast enough. The processors would melt themselves in minutes.
Wow, literally melts.
Yeah. You cannot easily retrofit a legacy data center to cool these chips. You have to pipe cold liquid directly to the actual silicon inside the server rack.
So a legacy data center company can't just, install bigger fans. They are structurally obsolete for this specific kind of AI workload.
Precisely. And Applied Digital saw this coming years ago. They broke ground long before the market caught up. So as a result, they currently operate one of the only 100 megawatt direct-to-chip liquid-cooled facilities that is actually online and functioning right now.
That's a huge head start.
It is. It's a massive first-mover advantage over competitors who are, frankly, still looking at blueprints and trying to get zoning permits.
And that reality clearly wasn't lost on the biggest player in the room.
Yeah.
We saw a $160 million direct investment into Applied Digital from NVIDIA.
That was a huge signal.
Right. I mean, that isn't just a vote of confidence. When the company designing the chips invests in the company cooling the chips, that is a massive supply chain catalyst.
Yeah.
NVIDIA needs to ensure that when they sell $1 billion worth of GPUs, their customers actually have somewhere to plug them in.
That's the exact strategic synergy at play there. NVIDIA is protecting its own deployment pipeline by funding Applied Digital's infrastructure.
Okay, I hear all of this, and it sounds great, but I really have to push back hard here.
Go for it.
We are talking about 100 megawatt campuses, direct-to-chip plumbing, massive grid substations. That is astronomically expensive. So how exactly are they paying for this rapid expansion? If you're building multiple multi-billion-dollar campuses simultaneously, how do you not completely wipe out the balance sheet?
Look, it is the single most important question for anyone looking at this stock, and the answer lies in incredibly aggressive, complex strategic financing.
Okay, walk us through it.
Let's break down where the money is coming from. First, they secured a $550 million revolving credit facility arranged by Goldman Sachs. That provides the day-to-day liquidity just to keep the lights on and the contractors paid.
Which is a nice safety net, but $550 million doesn't build a massive AI campus.
Right, it doesn't. So on top of that, they issued massive senior secured notes. And when I say massive, I mean it. We're talking $1.59 billion just to fund the ELN04 building at Polaris Forge 1.
Jeez.
And another $2.15 billion for Polaris Forge 2.
Wait, hold on. $2.15 billion for a single facility.
Yeah.
That is the GDP of a small country.
It really is. The capital intensity is wild. But here is the brilliant strategic move they are making to clean up this balance sheet they're spinning off their cloud business, Chronoscale.
Break that down for us. Why does spinning off the cloud division help the infrastructure division?
Think about the two different business models. The infrastructure side, what Applied Digital is keeping, is essentially a specialized real estate business. You build the shell, you provide the power and cooling, and you collect rent. It's predictable.
Okay, right.
The cloud business, however, requires you to constantly buy the actual servers and GPUs. Buying tens of thousands of GPUs is a massive, never-ending capital drag. By spinning off Chronoscale into its own independent entity, Chronoscale can go out and raise its own capital to buy chips.
Oh, I see.
Yeah, entirely taking that massive expense off of Applied Digital's books. It allows Applied Digital to focus strictly on those highly predictable 88% margin infrastructure returns.
That makes total sense. So the foundation is set, the financing is lined up. But from an investor's perspective, what are the actual triggers we need to be watching for? What are the upcoming catalysts over the next 3 months that could, fundamentally change the stock price?
Well, first up on the calendar is the fiscal Q2 2025 earnings call in November. That call is going to be absolutely critical.
Because everyone wants an update on construction.
Exactly. The market doesn't just want to hear a victory lap. They want hard updates on the construction progress of that ELN04 building. And more importantly, they're looking for forward guidance that accurately models this massive new backlog of revenue they've just secured.
And we also have the Chronoscale funding round coming up, correct? How does that work if it's an independent company now?
Right. It's an initial independent funding round, meaning outside investors will put money into Chronoscale. When that happens, the open market will establish a concrete valuation for Chronoscale.
And that benefits Applied Digital directly.
Heavily. Here's why that matters. Applied Digital is retaining a 97% ownership stake in Chronoscale. So the moment Chronoscale gets a high valuation from outside investors, it instantly unlocks massive equity value on Applied Digital's own balance sheet.
Got it. We also have to keep an eye on the broader macro tailwinds. We are seeing accelerating capital expenditures from hyperscalers across the board, but a very practical catalyst is the easing of supply chain bottlenecks for physical components.
Which has been a nightmare lately.
Yeah, we're talking about massive industrial switchgear and industrial generators. I mean, you can have all the money in the world, but if you can't get the physical switchgear delivered, your data center is just an empty warehouse.
Exactly. So the fact that those supply chains are easing means construction timelines are becoming far more reliable, which drastically lowers execution risk.
But let's talk about the elephant in the room. The mystery hyperscaler who signed that $5.2 billion lease. Is the identity of that hyperscaler already fully priced into the stock? Or could the actual reveal, say they announce it on the November earnings call, cause a secondary re-rating of the stock?
It's the multi-billion-dollar question. Right now, the market has priced in the revenue they know the $5.2 billion is coming, but confirming the identity could absolutely cause a secondary re-rating.
Why is that?
Because of counterparty risk. If the mystery tenant is confirmed to be one of the top 3 global tech giants, Microsoft, Amazon, or Google, it fundamentally proves that the lease is ironclad. Those companies don't default on rent. When counterparty risk drops to basically zero, Wall Street models are willing to assign a much higher valuation multiple to that future revenue.
That perfectly transitions us to the chart, because the market is already reacting strongly. From a price structure perspective, we are looking at a definitive bullish breakout. Shares have soared roughly 60% year-to-date.
They have. And if you zoom out, as we mentioned earlier, they've more than tripled over the past 12 months. What's crucial for traders to understand here is the nature of the breakout.
It's not a meme stock thing.
Right. This isn't just retail enthusiasm or a hype rally. The breakout from previous trading ranges into this long-term uptrend is heavily driven by fundamental news and contracted revenue.
The volume and flow dynamics are what really catch my eye here, though. You mentioned those massive high-yield debt offerings earlier, raising billions of dollars. Well, it turns out those offerings were 5 times oversubscribed.
Yeah, let's explain what that actually means for the listeners who might not track fixed income markets every day.
Right, so being oversubscribed means it's like trying to get front row tickets to the biggest concert of the year. There were 5 times as many institutional investors trying to lend Applied Digital money as there was actual debt available.
That's a great analogy.
And the fixed income market, bond buyers and lenders, they are notoriously conservative and risk-averse. When they are fighting each other for the privilege to lend you billions of dollars, it indicates immense, deep-pocketed institutional flow supporting the broader equity story.
Absolutely. The smart money is validating the business model. And when you have massive momentum breakouts and institutional flow like this, the charts can get incredibly volatile and tricky to navigate.
For sure.
That's a great example of where a tool like VIP Algos can be really helpful for traders. By scanning for support and resistance levels naturally, you can see where those structural price zones actually reside during these high volatility moves, rather than just guessing where the floor is.
So the chart gives us the price structure and the momentum. But let's zoom out and look at the broader market sentiment. Wall Street seemed to be absolutely eating this story up.
The narrative is decidedly bullish. Wall Street loves nothing more than a story where a company takes hypothetical pipeline capacity and successfully converts it into actual investment-grade contracted revenue.
Mm-mm.
And the sheer size of Applied Digital's backlog right now is
It's
staggering.
just huge.
That new $5.2 billion lease we keep talking about, it pushes their total contracted base term lease revenue to $36 billion.
$36 billion.
Yeah.
That is a number that is hard to even conceptualize for a company of this size.
It is. It's spread across 5 massive campuses, and the key detail is that 70% of that $36 billion is backed by investment-grade hyperscalers.
That changes the entire math of the company. It goes from a speculative build to a guaranteed annuity, and the analysts are reacting exactly as you'd expect to a $36 billion backlog. Currently, all 13 analysts covering the stock maintain buy ratings.
Unanimous.
Yeah, we've seen a massive wave of price target upgrades. Needham raised their target to $83, Lake Street went to $90, Compass Point is up to $70, and B. Riley sits at $66.
And hovering over all of those analyst upgrades is the speculative buzz we touched on earlier. The market chatter regarding the identity of that mystery hyperscaler is at an absolute fever pitch. The speculation strongly points to a mega cap giant like Microsoft, Amazon, or Google.
Beyond the analysts and the rumor mill, you also have serious, quiet institutional capital stepping up to the plate. Macquarie recently made a $5 billion commitment to Applied Digital's projects.
That was massive.
Yeah, when an infrastructure giant like Macquarie commits $5 billion, that is top-tier institutional validation. They have armies of engineers who audit these blueprints before they write a check.
The sentiment picture is incredibly strong, no doubt, but we cannot paint a one-sided picture here. We have to talk about the risks, because the downside on a project of this magnitude is severe.
Yes, let's firmly put the skeptical lens on. Because as much as we talk about $36 billion in future revenue, the aggressive debt accumulation happening right now is impossible to ignore. Raising roughly $4.3 billion in a single quarter is a staggering amount of leverage.
It's a lot of weight to carry.
And this isn't cheap money they are borrowing. They issued sub-investment grade secured notes with a hefty 7,000% coupon. Just doing the rough math on that. They're looking at hundreds of millions of dollars a year purely in interest payments. If execution falters even slightly, like if a construction delay pushes back a facility opening by 6 months, that debt load instantly becomes a sinking anchor.
The sheer scale of the debt is undeniably the primary risk. It's the sword hanging over their heads. But to understand how the market is stomaching this, we really have to look at how the debt is legally structured. This debt is heavily mitigated by the fact that it is non-recourse at the project level.
Okay, explain that for us. What does non-recourse actually mean in a worst-case scenario?
Think of it like a mortgage on an investment property, but with a special clause. If a specific campus project completely fails, say, Polaris Forge 2 goes bankrupt, the lenders can foreclose on and take that specific facility. But because it is non-recourse, the lenders cannot necessarily go after the parent company, Applied Digital, to liquidate the rest of their assets to get their money back.
Oh, wow.
Yeah, it insulates the core company from a total catastrophic collapse if one single project goes under.
That's a massive safety valve.
It is. It's structured at roughly an 80% loan-to-cost ratio. And more importantly, the banks are willing to agree to those terms because that debt is explicitly backed by that $36 billion in guaranteed investment-grade contracted revenue. The banks are looking at the ironclad 15-year leases signed by these tech giants, and they are lending against that specific credit quality rather than just Applied Digital's standalone balance sheet.
Okay, that covers the financial risk. But what about the physical execution and the AI supply chain risk? We keep hearing about massive bottlenecks. What happens if there are major disruptions in high-end processors from NVIDIA or AMD?
Good question.
I mean, if the chips are delayed by a year, the data center sits empty. How does Applied Digital survive if they aren't generating rent?
This is where their contract structure is absolutely brilliant, and it's a concept called take-or-pay leases.
Sounds intense. How does it work?
Under a take-or-pay agreement, the customer, the mystery hyperscaler, bears the entire hardware procurement risk. Think of Applied Digital simply as the ultimate landlord. Their only job is to provide the powered, cooled, and secure infrastructure by the agreed-upon date.
Okay, so they just hand over the keys to a cold room.
Exactly. If the tech giant can't get their hands on the NVIDIA processors in time to fill the building, they still have to pay Applied Digital the full rent for the capacity. Applied Digital gets paid for the infrastructure regardless of short-term supply chain bottlenecks in the global chip market.
Wow. So they've effectively shifted the biggest risk in the AI hardware space directly onto the shoulders of the world's richest companies.
Exactly. It's a masterclass in contract negotiation.
So putting all of this together, the $36 billion backlog, the 88% margins, the massive debt load, and the brilliant contract structures, what is the final verdict on the stock?
Looking at all the synthesized data, the final bullish score lands at a very strong 9 out of 10. The overarching investment view here is moderately to strongly bullish, specifically looking at a multi-year hold horizon.
To summarize the thesis for you, Applied Digital has positioned itself as a premier AI infrastructure play. They have moved past the speculative phase and are actively transitioning into a massive, predictable cash flow generator.
A huge transition.
And that thesis is validated by a $36 billion backlog, a massive 1.4 gigawatt pipeline of future power capacity, and direct strategic investment from the very top of the food chain in NVIDIA.
But caution is always required, especially in infrastructure. We must reiterate that while the upside driver here is massive scaling optionality, the main risk remains the heavy leverage and the absolute requirement for flawless execution.
Right.
There is zero room for sloppy project management or delayed timelines when you owe billions in high-yield debt. And as always, we want to remind you that this analysis is an educational talk, not financial advice. Always weigh your own risk tolerance.
And if you want a cleaner way to read the trading charts as this stock continues its breakout, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this talk helped you understand the AI infrastructure space a little better, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua analysis.
I just want to leave you with one final thought to mull over. We talked about Applied Digital having a 1.4 gigawatt pipeline of power capacity just to keep these new chips cool. 1 gigawatt is roughly enough to power a medium-sized city. As these massive AI campuses scale globally, how long until the biggest bottleneck isn't the supply chain of silicon chips, but the physical limits of our local community power grids? It's something to seriously consider as you look at the infrastructure of the future. See you next time.